trading idea is just an idea. How do we translate a trading idea into a profitable plan? Stick around. There really are three components to being a consistently profitable short-term trader. And in today's video, we're going to focus on the third component, which from my seat is a pretty big stumbling block for traders who are starting out, whether that's traders developing on our desk or those who we've trained outside the firm. And so let's walk through each of the parts. Step 1, step 2, and step 3. And after we kind of walk through 1 and 2, we'll spend our time focusing on the third step. So step number 1, of course, is stock selection. You've heard me talk about this countless times. The reason I talk about this countless times is without proper stock selection, without being in the right in-play names, at best, you're 50-50 whether or not you're going to make money. If you want to learn more about stock selection, it's in other videos. I actually spend 30 minutes in the free 2-hour workshop we put together. So click on the link above. In that workshop, 30 minutes on stock selection, that will get you going. Also tradingworkshop.com, find out more about that workshop. Step 2 is identifying areas of interest. These are prices that stocks tend to trade to after they have a catalyst. These are also prices that if a stock can move through, they may have an explosive move. So, and you've seen, again, you've seen these areas of interest when we post the morning game plan, the notes from the morning game plan. And so those are the two things. Number 1, stock selection. Number 2, areas of interest. And I think what I've seen, I've seen developing traders on our desk get through 1, get through 2, and then don't really follow through on the third part. And I think that's an early stumbling block for developing traders. And that's really developing a detailed trading plan for your ideas. And so what I want to do today for you is kind of walk through from a couple of days ago, the game plan notes for fresh in play stocks. And again, this was I just grabbed this randomly. I could have gone and back and picked a day to illustrate the lessons perfectly that I'm going to teach to you, but I grabbed a day, and we're going to work with the 3 stocks that I was focused in on that day, and I'm going to show you the bigger picture. I'm going to show you what they did on that particular day and kind of walk you through my thought process of how I'm going to develop plans, how I'm going to execute on those plans, and how eventually, once you do that on a consistent basis, that's going to lead to you being consistently profitable. When I say consistently profitable for an intraday trader, there's 22 trading days a month. Once you get this process down and you've been doing it for a long period of time, experienced traders are generally going to be profitable 16 to 20 days a month. You know, they're going to have a couple of negative days a month. Maybe they'll even have 4 or 5 negative days. If it hasn't been a particularly good month, maybe their setups just weren't working, the numbers didn't quite work out. But there's no reason for an intraday trader who's getting as many reps as they are, is looking at many different in-play stocks, not to, at the end of the day, be consistently profitable once they've developed proper stock selection, identified proper areas of interest, and then developed detailed trading plans. Here's a couple of things, or more than a couple of things. Here's kind of a list of some of the things I think about before we get into looking at the individual names from the chart, from the morning game plan sheet that I just showed you. So the first thing is, do I have a strong bias? And if the answer is yes, I'm going to be more aggressive in that first 15 minutes or so, putting on a trade in the direction of my bias. One of the things you might be surprised to learn is the vast majority of the time, I do not have a strong bias. I would say 70, maybe even 80% of the time, I don't have a strong bias. What I do have is I've identified a stock with a strong catalyst, and then what happens after that strong catalyst, it gaps higher or lower to new prices. And so the reason for the most part why I don't have a strong bias once that stock is gapped is a lot of that information may have been priced in after that big gap up or that big gap down. So, and just off the top of my head, I can think of maybe 2 or 3 stocks in the last week or so that I've actually had strong biases on One was Twitter on the short side, one was Tesla on the long side. And those stocks had big gaps. And so one was a big gap up, but I was still prepared to trade it on the long side. One had a big gap down, and I was still prepared to trade it on the short side and be aggressive with those biases. But quite often, the catalyst will come out, the stock will gap to recent resistance areas or recent support areas, and stocks will move, will identify the S1, what we call our support, our first support level will be S1, our second support S2, our first resistance R1, our second resistance R2, and if that news has been factored in pretty well when the stock opens, it'll bop up and down between S1 and R1, and sometimes it'll move outside of that, but quite often we'll just move up and down inside of that range. You need to have a plan for that. Walk through mentally the potential patterns the stock may follow. So by doing this, I'll be able to react more quickly as information begins to come in when the market opens at 9:30. Things can be moving very quickly. I'm taking information. I am now not reacting as much as saying I've had these mental pictures and images of what the stock potentially can do, and as it starts to do things and that unfolds, I can say, oh, well, we considered that as a hypothetical, like that was one of the price patterns we were looking for. It now seems to be supporting that one. Now I can trade it more aggressively and more comfortably because I've already done the mental rehearsal in my head. I think this will become more clear for you when we take a look at the Roku charts in a minute. So number 3, be prepared to regularly update my expectations as the market gives me more data. For example, if a stock is trending, what price action would I need to see to start to think that perhaps the trend is ending? This will be applicable when we take a look at the spot chart in a minute. Number 4, know in advance, before you enter a trade, exactly how much you're willing to risk. And think about your risk in terms of units. Increase number of units of risk based on more information. I think when we take a look at the TIF chart, TIF, it's going to illustrate this point really well. Number 5, understand how much liquidity a stock is offering before entering the position. You can figure liquidity out based on how much average daily trading volume a stock does. You can also look at what type of volume it's done in the pre-market before the market actually opens to give you an idea of what the liquidity is going to be like. A stock that is very active in the pre-market should have great liquidity once the market opens and there are more market participants. Number 6, how much time must a stock, and again, this is just the list of things that I'm thinking of, and it's not exhaustive. I'm going down, I have 7 or 8 ideas here. There's probably another 5 or 10 things that I'm thinking about. And what you'll find is, when you're in your first 6 months of trading, you're going to have to kind of have your list written down because you haven't internalized these things. And then after a year, you'll have internalized most of these things. And after several years, there's just so many things that you've internalized. It's just this really long list that you're not going to have to proactively have to write down. But when you start out, you're going to be writing these things down, especially the detailed trading plans. And one of my favorite traders, who's not a part of the firm, who did a video at least once for us before, a very experienced trader, very profitable now, started trading in college. Quite often, as part of his morning prep, what he would do is he would say, I'm looking at Roku this morning, and he would show you a detailed plan of exactly how he would trade it, what he'd need to see to trade it on the short side, or what he would need to see to trade it on the long side. And this is somebody who's been trading for many years and is extremely profitable, but still, even to this day, he was writing it down for his top 2 or 3 names just to help him, just his process of visualization and internalization, so he could be more aggressive when things, the market opens and there's a lot of stocks moving around, there's a lot of information coming in, and things are moving really quickly, but part of his process was to write this down in detail. And it just so happens that the better, more successful traders tend to do this as part of their routine. I believe we were on number 6. So how much time must a stock hold above or below a level before you enter a position? On the 3 examples that we're going to take a look at, I'll show you what that looks like. Number 7, how far must a stock move through a support or resistance level for me to believe it's likely to continue in that direction with momentum? And then finally, number 8, this is developing a series of profit targets. Most prevalent ways to think about this are, number 1, based on a stock's volatility, you're going to develop profit targets. One of the ways you can measure volatility is look at the ATR. We've talked about this before, the average true range. That's measured from the prior day's close to today's close is the ATR of a stock. Generally, trading month is 22 days. Go back 22 days to figure out what the average ATR is. That's going to give you a measurement of volatility. And then for profit targets, if I get long something, generally, if it moves half of an ATR, that would be a spot where I would potentially take 25% of the position off to cover the risk of the trade. And then the other spot to look for profit targets are support and resistance areas. And again, those are generally covered when we just showed you before the morning game plan notes. Those areas of interest, S1, S2, S3 sometimes, R1, R2, R3. So I just rattled off 8 of the things I'm thinking about in terms of how to develop a detailed trading plan so my executions are going to be more consistent and my results are going to be more consistent. Not an exhaustive list, but I think that's a pretty good start for you. So let's get into 3 of the names from that game plan sheet. The first one is Roku, R-O-K-U. This is a momentum stock. And what we're looking at here is the last few weeks price action. A couple of points of interest. And I'm trying to give you an idea of what I was thinking about before the market opened. And then we'll show you the drilled down chart. So as I'm developing my trading plan, what I'm thinking about is after the stock had bottomed about a month ago, it moved to higher prices. It moved up to about 105 to 110 or so, 106 to 110 maybe. And I circled that on the lower left-hand side. You can see that big green circle. And it compressed the range and had support area. It had a resistance area. And then a catalyst came out. I don't remember what it was. I don't think it was particularly that important. But it was enough for it to gap outside of that range from the prior 3 or 4 trading days. And it had really good follow through. And then the next couple of days it moved higher. It moved higher as well. And so you can see about a week and a half later, after it had run up to $139 a share and came off really hard to the mid 120s, it then started to compress again between 127 and 130, just eyeballing at the charts pretty far from me. But you can notice I circled that area. It was pretty similar to the prior consolidation in terms of the amount of time that it had before a catalyst came out and it had gapped up. And so my thought process was, okay, it had just had a big run up after the prior catalyst. It had pulled in, it was consolidating again, it was compressing, and it had an upgrade from Bank of America, and it was gapping outside of that consolidation range. So potentially this is the beginning of another up leg. But at the same time, if you look just to the left of the area I circled, where did the stock most recently have its really hard down move? It was exactly to where it was gapping to right now. Now, you can say the argument for it not having that same failure, or at least that large of a failure again, it's had some more time to digest the move from the last couple of weeks. Buyers have stepped in the high 120s. People are long for much higher prices now. So, the first time it got up to 139, people were long from 105, 110, 115. They were very profitable at that point in the high 130s. Perhaps it was going to have a hard down move. But here, if we look at where people were long from the prior few days, they're still long from below 130. So when the stock gaps to 138, 139, and people look at that and see it drop $10 very quickly from there in one day, even more, I believe, looking at it, you're going to have some people potentially who are going to be selling at 139, 140. And so I'm mentally prepared for it to fail in the 139, 140 area. We have that on the sheet, I believe. Roku, first resistance potentially 130. I've circled the second one, 140, because it actually broke out from there. And I'm prepared that right on the open, and let's take a look at the intraday chart now. The intraday chart, and what you can see is I've highlighted R1, R2, 139, 140. And so I'm developing a plan. My plan is basically like on the open, if it pops back up into the 139 to 140 area, well, my first thing is R1. If it actually goes to R1 and they're selling right off the bat, I'm going to look for the stock to come off $2 to $4 because it's a very volatile stock. And so right on the open, if I'm watching it, if it's my primary stock and it gets to 139 and I see it's being sold and then it's below 139, 138.70, I'm going to look to short it against the high of the day. If right on the open, it actually goes straight through 139 like it did and goes up to R2 and spikes above it, I am going to look for one of two things to happen. And again, this is all happening in the first 15 minutes. And the rules for the first 15 minutes are different than what happens after 10 o'clock because things are moving quickly. And so we talked about above and below a level. If it gets above 140 right on the first 10 minutes like it did, I'm going to look for it to spend 5 or 10 minutes above 140 before I start to believe that perhaps this is going to trend higher for the morning. At the same time, once it's spiked above R2 on that second green bar, we're looking at the 5-minute chart, if it's below 140, and you can see it actually went spiked up to 141 and was below 140 within a couple of minutes. If it starts to hold below 140 for more than a few minutes, I'm going to actually look to nibble on the short. But on my confirmation, when I say nibble, quarter position at most, my confirmation is it goes below 139 R1 and starts to hold. At that point, I'm a real believer in the short, and I'm looking for it maybe to move back down to 135, 136. So in this case, that didn't unfold. The scenario of it actually following through to the upside unfolded. And if we're looking at the 5-minute chart, after the first 2 bars, we have one. The next bar where it had spiked below 140, it actually closed above. And then we got 2 more bars where it tested 140 2 more times and held. That's very bullish. And what I'm going to say to you is what I used to teach traders on the desk 5+ years ago, maybe even up to 2 or 3 years ago, was what I'd really like to see is a longer consolidation. But this actually happened before 10 o'clock. So a 10-minute consolidation is sufficient. But I will say that after 10 o'clock, we used to look for 20 to 30-minute consolidations. Sideways consolidation is sideways price action in a tight range. I don't know if the market-making programs or the quants picked up on this common pattern of the 20 to 30-minute tight horizontal consolidation after 10 a.m., but we're seeing it left often. So what you need to do now is actually look for a 10 to 15-minute consolidation for confirmation that something is going to follow the direction of the opening drive. So that was Roku. I thought that illustrated quite a few things. The second name was TIFF. And on TIFF, I can tell you that I definitely did not have a bias. My thought was there could potentially be money on both sides of this one. The news on this one was they received an unsolicited takeover offer at $120 a share. I wanted to show you the higher time frame so I could explain to you exactly what I was thinking when this news came out. So they received a takeover offer at 120. You can see bigger picture. The stock had sold off last year from 140 all the way down into the 80s, kind of double bottomed. It had failed at 110 more recently off of that bounce from the 80s. And the takeover bid was at 120. You can see I marked it there on the chart view. It's gapping above 120. And I've highlighted potential upside areas. Now, 130 I thought was realistic. The bid was 120. They hadn't come to a deal. It basically was just presented to Tiffany's. When that happens, when a company is presented with a takeover offer and there have been no discussions and no announcement of a deal, that generally leads to negotiations and some sort of higher price. The question is, is the higher price going to be 125, 130? Best case scenario is 140, but that's aggressive. That was like the prior all-time high. It had come off, it sold off 40% from that price. So the likelihood of them getting that price, and let's say they even got that price, it still is going to generally trade at a discount to the final takeover price, maybe let's say 5%, and that's going to get you to 133. So I thought realistically it could get to 130, maybe even work its way a little, $1 to $3 potentially above there, but it was a stretch. But having said that, I was confident it would trade above 120 and perhaps maybe even back, it would trade to 130. I think if we look at it in the pre-market, what we can see is that it had already in the pre-market traded up to 130. You can see it on the left side of the chart, but also I've highlighted S1. S1 was 126, $6 above the takeover price, and in the pre-market, this was trading very heavy. It actually traded maybe even 1 million shares in the pre-market, and several 100,000 were being bought at the 126 price once it got above it and pulled back into it. You can see it was moving sideways from about 7 to 8 o'clock in the morning. And then as we got closer to the open, 8 o'clock institutions start trading. We've talked about that many times before in the videos. And when the institutions started to trade after 8 o'clock, it actually popped up to above 130, got to maybe even 131.5, 132, and then started to trade back down towards the 126. So I was prepared. I was prepared to trade on the long side at 126. I was prepared to trade it on the short side if I could see a seller after the market opened at 130, because that's kind of where it came off from in the pre-market after failing above. And so I was pretty much married to the idea that it would be a range, but also that it could go both above and below the range that I'd highlighted there for the S1 and the R1. If it went below S1, maybe $1 to $2, then there was no real support, probably. What I'd say real is the takeover price, 120. But I also thought by the amount of people that were willing to pay up to 126 in the pre-market, a $1 to $2 down move from there, you might get some more buying. And if it moved back above 126, it would trade in range again. On the upside, my thought was, after buying it at 126 and a pullback right on the open, if it got up there and failed once and then came up again and failed a second time, maybe I would look to short it. But again, no strong bias here. The initial takeover is 120. This isn't something that beat earnings like a Tesla, raised guidance, 30% short interest, where going forward it might have some more upside. This was kind of like the price is known. The price could move higher, but not that much, because that's just how deals are done. And then you got to go to where prior prices where the stock traded, and it's definitely not going to be taken over above the prior all-time high. Maybe they'll move up from 120 to 125, 130, or a little bit above there. Stocks trade at a discount to their takeover prices, and so that kind of lands you from the low 130s to like the mid 120s, maybe even the low 120s at worst case. And so what happened in this case? It pulled back to 126 on the open, got long. Initially it spiked below, got stopped out. They rebid it, got long again, and then just rode it back up for the $2 to $3 initial move, and then finally topped out at R1. What I want to talk to you a little bit more about here is the idea with using levels. In this case, we already knew that several 100,000 shares have been bought at 126 in the pre-market. So we're pretty much ready to buy it there as soon as it comes down there in the open. And then after about a minute or two, if it hasn't gone through and isn't holding below, buy some more. And then what you want to see it do is move back up to above 127. Once that happens, you're going to trail a stop, probably below 126.5 for some, and then below your initial stop below 125.5 or so as well. And you're deciding the risk there based on what's the reward. The reward is potentially a move back up to 128 to 130, a $2 to $4 move based on just prior price action from the pre-market. And so you definitely can risk 50 cents on this one. It's pretty good risk reward. And then finally, I think the third name that we had on our sheet from the Fresh and Play that day was Spotify. And Spotify, the thing that caught my attention, and I put it in the notes, was there was good year-over-year growth. It was 30% year-over-year user growth. And so when something's growing that strongly, I want to see where it is in relation to the highs. And if it's not close to the highs and the growth is good, I'm going to look for some buyers to step in. And at the same time, I want to know exactly where it was a year ago to see if it's been able to digest. If it isn't that much higher than where it was a year ago and 38% year-over-year growth, it's got some upside. In this case, on the higher time frame chart I circled a year ago, the stock was like in the 140s. After that, in the October to December sell-off, it sold all the way back down to close to $100. But even with the morning's gap, with this good news, if we go back a year, it hasn't taken out that the prices where it was trading in the prior October. So at this point, it's a large gap to the upside. So I want to actually see the buyers step in and hold above those first resistances I've highlighted on the intraday chart for you there at 133 and 135. But if it can actually take out those resistance areas and hold above them, then I'm going to be thinking out over the next few days, maybe it will work its way back to where it was a year ago in the low to mid 140s. At the same time, ideally, what I could get is potentially a dropout into S1. What I'm thinking is 30% year-over-year growth. It's below where it was a year ago. It's a large gap, so maybe I can get a quick spike down into S1. I can get long into S1, and then if I can actually see it start to hold above R2, this is a stock that potentially I'm looking for a bigger trend, and it's become a swing trading stock. Now, the other thing I want to talk to you about this stock, because it trended so cleanly, is what happens in a stock if it doesn't drop out to S1 on the open, and the first move right on the open is above R2, and we're looking at actually a stock that didn't really have much of a consolidation period. We're looking at the lower time frame chart here. So it's a 5-minute chart. So it had like an okay consolidation, but the issue is it's not that far below R3. So it's not a great risk to reward. And so what we want ideally is a move to R3 and then a very shallow pullback and a tight sideways consolidation. And in this case, what you got was it got to R3, it came off like $2.50 very quickly and then spiked right back up. And we got no sideways consolidation, no 15 or 20-minute consolidation. And it just took out R3 and just started to kind of trend. And so there was kind of like one spot there where you can see the green bar, the red bar, and then the green bar above 135 before it started to trend there. But I thought in this case, for a less experienced trader, there really wasn't enough sideways action above R3 to actually get involved. And so unless you were involved from the initial drive above R2, when it held R2 there, you weren't getting in. And the only really low risk spot to get in, is that not even on the chart here that I'm showing you, is when it actually finished its uptrend in the morning to 142 and it pulled all the way back in the afternoon to R3. That was like your first spot to step in. And I think what happened was it hit R3 in the afternoon. It ended up going up $2 or $3 from there. And then it's been a swing trade ever since. And so one of the things I wanted you to think about was sometimes a stock like this will just be really strong and ended up being like a great stock over the next few days in terms of moving back up to those prices from last year. But it didn't really give you a great entry until it really showed you the strength above R3. You had that nice, it had about a $5 move from there. And then in the afternoon when it drifted back into R3, you knew it had the strong opening drive. You knew it broke out from R3 and had a clean trend. Buy it when it pulls back to R3. Your risk in that case is to below 135, but your upside is the morning high. And then if it closes above 140, like I believe it did, so I don't have the chart in front of me right now, you're in a place to actually capture a swing trade to the upside. So I thought those were 3 pretty good examples right off the sheet. They behaved, they all actually gave really good trades. And the fourth one, Microsoft, I actually traded as well, but I didn't think it presented as much of a great setup to discuss based on what I wanted to talk about today. But there was opportunity in all of them. And really what it came down to, the key was, were you prepared based on the prices that we had set up for support and resistance to develop detailed trading plans based on the price action? How did it move through those levels? Did it fail at the levels? Did it break through? Did it support the levels? Etc. How much time did it spend above? How much time did it spend below? Knowing those things in advance is going to make you execute consistently across the board. When you're doing your weekly review, you're going to see the number, your numbers start to look a lot more consistent. So hopefully you were able to learn something. And by all means, in the comments section below, if you had a question about what we talked about today in Spot or TIFF or Roku on these different setups, the different things I talked about, ask a question. Or if you traded these names or you understand these types of setups, kind of walk us through your process. What are you doing in the first 15 minutes? What are you looking for? How are you changing things up after 10 a.m.? We can all learn from your questions. We can all learn from your comments. Thanks.